want to show you Facebook, Microsoft, Amazon, Apple, and Nvidia, how much they've drawn down. And we're going to talk about if it looks like good opportunities to buy or not, and just look at what has happened historically. How often have they been down, all of them at the same time, more than 25%? Not many times in history. I know this graph and chart is a lot. Let me explain it. In the top part, you can see how much these stocks are down. So Meta, 57% down from all-time highs. Apple, 25%. Microsoft, 25%. Nvidia, 54%. Amazon, 43%. That's how far down they are from all-time highs. This chart shows how often over the last about 25 years they've been down from all-time highs. And what I want to show you as I hover over this is there's not many times when all 5 of these stocks have been down 25% from all-time highs. Even during COVID, at the end of March, which is basically peak fear, they weren't all down 25%. We had Meta down 25%, but then things quickly recovered. We had a pretty bad pullback in tech in 2018, but even here, Microsoft was only down 12% and the rest were down. Nvidia was down 53%. That was the crypto stuff. Meta was down 39%, Apple was down 32%, but in my opinion, that's not as bad as where we're at right now in terms of down from all-time highs. So back up a little bit. In 2009, it certainly happened. That was one of the worst sell-offs we've seen in the past 100 years. Apple was down 32% from all-time highs, Microsoft down 64%, Nvidia down 73%, and Amazon down 27%. So yes, it happens. 2002, after the dot-com bust, it happened. But really, when we're looking at the past 25, 30 years, there's 3 or 4 times that they've sold off this bad. So A, this happens, and B, it doesn't happen that often, but when it does, that's not the time to be selling these stocks. And if anything, it's the time to be thinking about seriously investing, adding, holding, whatever. If we look at $10,000 invested in these stocks since 1999, which I took Meta out because they weren't public back then, $10,000 in Apple, $3.7 million is what it's turned into. Microsoft, $66,000. Microsoft was at a incredibly inflated high back in 1999. And so has not been that impressive if you span it out that whole time. But what that still shows is even if you bought Microsoft at, I think its absolute highest price to sales multiple or price to earnings multiple ever, I would have to look back, you've still made money if you held long enough. Nvidia since then, $10,000 to $3.74 million. Amazon, $10,000 to $300,000. So the lesson there is even if you bought these 4 stocks, you bought Microsoft at its absolute all-time high in terms of PE multiple and price sales multiple, didn't do so well in Microsoft, but because you were a little bit diversified, you made life-changing money if you held over time. Okay, even if we just back it up 10 years, $10,000 in each of these stocks, even after this crazy sell-off, you've still turned a total of $50,000 into something on the range of $600,000. So 10x, 11x, 12x your money in 10 years. So now we've gone a little bit from kind of the history of these sell-offs, how much these stocks have sold off over time, how frequent that happens, and obviously the strategy of just trying to hold them long-term. But we do want to think about what are the current valuation metrics, how do they compare to each other, and then what do they look like going forward in terms of potential returns. So let's do that right now. This is Seeking Alpha, cool way I can compare these stocks. We've got Meta, Apple, Nvidia, Amazon, and Microsoft. We can tell right now by market cap, the smallest market cap is Nvidia, 400 billion, Meta about 450, and then Amazon just over 1 trillion, and Microsoft and Apple right around 2 trillion. In terms of ratings, at least according to Seeking Alpha, they all get a hold on their quant rating. You've only got 4 buys in the SA authors rating, and then Wall Street calls all of these stocks a buy with Amazon and Microsoft as strong buys. These stocks are all just down huge. We talked about this, but over 6 months, Meta down 52%, Nvidia down 48%. Over the last month, Meta down 16%, Apple down 7%, Nvidia down 17%, Amazon only down 5%, and Microsoft down about 5%. If you're looking for some dividend payers, the only ones here that pay, Apple 0.66%, Nvidia 0.10%, and Microsoft 0.95%. The dividend growth over the last 3 years, Microsoft has grown the dividend about 10% CAGR, compound annual growth rate, Nvidia at only 0.5%, and Apple at about 6%. And then over 5 years, Microsoft's still up there around 10%, Nvidia just under 4%, and then Apple right around 9%. So if you're looking for dividend and dividend growth, Microsoft is interesting there. And then let's start to get into valuation. So we're going to talk about valuation here, but then I'm going to use fast graphs to show you kind of what they look like with forward expectations as well. This right here shows us forward 1 year, 2 years, and 3 years based on expected earnings, what their PE ratios, their non-GAAP, so that's adjusted PE ratios, what they look like. So Meta is actually the cheapest on a 1 year forward non-GAAP PE basis at just under 14. And we've got Apple at around 23, Nvidia at about 28, Microsoft at about 28, and then Amazon PE ratio is not a good metric to grade Amazon off of. If we go out 3 years, Meta's down to 10, so this factors in a little bit of that earnings per share growth. Meta's down to 10, Apple's at 20, Nvidia's at 20, Amazon's at 25, and Microsoft is right around 20. Now let's look at forward revenue growth to see which stock analysts are thinking is going to grow revenue fastest over the next fiscal year. We've got Meta with 19% forward expected revenue growth, Apple right about 15, Nvidia at 33, Amazon right around 16, and Microsoft right around 17. So all, mid-teens, with Nvidia leading the way at 33%. Over the last 5 years, Meta has grown revenue at a compound annual growth rate of 31%. That's actually the fastest out of all 5 of these, with Apple the slowest at 11, Nvidia at 31, Amazon at 27, and Microsoft at 16. Okay, let's look at diluted earnings per share forward expected growth. Meta, or Facebook, I'm always going to call it Facebook, is right around 11%. Apple, 25%. Nvidia, 37%. Amazon, 8%. And Microsoft, 23%. Over the last 3 years, compound annual growth rate for EPS growth has been Meta at 25%, Apple at 27%, Nvidia at 41%, Amazon at 20, and Microsoft at 28. And so what we can see here is not only has Nvidia grown their EPS the most on average over the past 3 years, but they're also expected to continue growing their EPS the most over the next year. So that's something to think about when we think about what these stocks look like going forward. Now let's get into some of these gross margin, net income margin, and profitability metrics. We've got Meta at 80%, Apple at 43, Nvidia at 65, Amazon at 42, and Microsoft at 68. So Meta kind of has the highest gross margin. But let's get down to net income margin. 31% for Meta, 26% for Apple, 32% for Nvidia, 4% for Amazon, and 37% for Microsoft. So Microsoft takes the win there with Nvidia, then Meta, then Apple, and then Amazon. Now, this is something that I want to pay attention to as we're in this kind of crazy macro environment, recession, headwinds, inflation. What is the revenue per employee? How efficient are these companies? Meta's at 1.64 million, Apple at 2.38 million, Nvidia at 1.2 million, Amazon 292,000. This is one of the reasons why Amazon has been in the doghouse so bad, is because they have high capital expenditure costs with all of their warehouses, all of the drivers, all of the workers. It's by far the lowest revenue per employee out of all of these companies. And Microsoft at 928,000. Now, when we look at net income per employee, it's actually even worse for Amazon, $13,316. Whereas Meta is at 479,000, Apple's at 661, Nvidia's at 420, and Microsoft is at 400. So Meta has gotten a lot of hate for the investments in the metaverse and AR and VR, and it's been super unpopular. But they're doing that from a standpoint of they had a business model with their advertising and their software properties where they were actually a pretty capital efficient business. And so they're taking that capital and investing into what they think the future is, the metaverse, AR and VR. There's a chance that this bet for Facebook, for Meta, really pays off, or they ruin a good thing that they had, a good model that they had, and waste a bunch of money, burn through a bunch of cash at exactly the wrong time on the metaverse. That's kind of everybody's fear right now. We know that the recent history's been terrible, right? But even after this crazy, insane drop, if we go out 3 years, and this is the time horizon I'm talking about, if we go out 3 years, Meta's only down 15%. That's not great, but still not portfolio crushing. Apple's up 181%. Nvidia's up 278%. Amazon's up 15%. And Microsoft is up 94%. Let's go to 10 years. This is why long-term horizons matter. 427% for Meta, 567% for Apple, 4,398% for Nvidia, 853% for Amazon, and 750% for Apple. Okay, this video is longer than I wanted it to be already, but I think it's an important video. I hope people actually watch it. I'm just gonna run through these and tell you if I think they're like overvalued or undervalued. If you want me to go more in depth on the current valuation and future return potential, let me know in the comments and I'll do another video with these same companies spending a lot more time on from here forward versus the history. So just let me know in the comments. Okay, at first look, Facebook is by far the most undervalued company out of all of these and potentially in the entire stock market. That's a broad statement, but it's extremely, extremely undervalued. And I can't even see the last time it traded at a price earnings ratio of 13. But we talked about the risks with Meta and their investments in the metaverse. And so that's there. And I'm not saying that it's the best buy right now, but it looks to be the most undervalued with obviously a lot of risk. Apple, compared to its average price to earnings multiple, which is this blue line, does look to be undervalued compared to its average normalized price earnings ratio. Normally it's at around 25, right now it's at 23. So Apple looks undervalued. Amazon, got to look at Amazon from an operating cash flow basis. Tends to be on average 27, that's this blue line. Right now it's at 20, which is way below that blue line. But again, lots of risk with Amazon and it's an expensive business to run, which is not good in this environment. Microsoft actually does not look undervalued. It actually looks overvalued still compared to its normalized PE ratio. But they've got one of the most consistent, secure, reliable businesses out there. They pay a dividend, they're growing the dividend. So, Microsoft is getting the benefit of the doubt. And even though it looks to be the most overvalued, might still have less downside than some of these other stocks. Or it might correct and it might come back in line with its normalized PE ratio. And that would not be good if that happens for investors now. Over time, probably would be fine. Nvidia has come down a ton, and it doesn't look super undervalued based on their current normal PE ratio, their average normal PE ratio, but with the expected earnings per share growth that we talked about, they're expected to have strong earnings per share growth, then it does actually look undervalued when we look forward. But this could come down depending on what happens with crypto and that sell-off and just graphics cards in general and semiconductors. These expectations might come down. Let me know in the comments if you want me to go more into the future expectations and return potentials for these companies, or if you have any other companies you want me to review. Appreciate you.